$1, that's all it can take. In 2026, if your income crosses $109,000 by a single dollar, the federal government can add up to $487 a month to your Medicare premium. Not a percentage of that dollar, the full surcharge. It's called IRMAA, and it works like a cliff, not a gentle slope. The strangest part, the income that triggers it isn't even your income from this year. By the end of this video, you'll know exactly where the cliffs are, why most retirees never see them coming, and the one situation where this surcharge can appear even when your income hasn't changed at all. Let's start with what IRMAA actually is. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain terms, it's a surcharge added on top of your standard Medicare premiums when your income is above a certain level. In 2026, the standard Medicare Part B premium is $202.90 a month. That's what most people pay. But once your income crosses the first threshold, the Social Security Administration adds a surcharge on top, and it climbs through 5 income tiers. Here's who it affects. The first threshold in 2026 sits at $109,000 for a single filer and $218,000 for a married couple filing jointly. Above that, you pay more. And this isn't a small adjustment. At the top, the Part B surcharge alone can reach $487 a month. That's nearly $5,844 a year per person on top of the base premium. Now, why does this matter right now, in 2026? Because of how the timing works, and that timing is exactly where the trap begins. The first thing almost everyone gets wrong about IRMAA is that they assume it's gradual. It isn't. IRMAA is a cliff. Here's what that means. Imagine 2 single retirees. The first has an income of $109,000 exactly. The second has $109,001, $1 more. The first one pays the standard premium. The second one can be pushed into the next tier and pay the full surcharge for that entire bracket. $1 of income. The same surcharge as someone earning thousands more inside that same tier. That's the cliff. You don't pay a surcharge on the dollar that crossed the line. You pay the surcharge for the whole tier. And because it applies per person, a married couple where both are on Medicare can face that surcharge twice. The surcharge is calculated on a sliding scale with 5 income tiers, topping out around $500,000 for a single filer and $750,000 for a couple. Each tier has its own fixed surcharge. Cross into it by a dollar and you're in. So if the cliff is this sharp, you'd think people would simply manage their income to stay under it. And some do. But here's the problem, and this is the part most people never see coming. The income that decides your surcharge isn't the income you have now. This is the mechanism that catches retirees off guard. Your 2026 IRMAA is not based on your 2026 income. It's based on your tax return from 2 years earlier, your 2024 income. The Social Security Administration uses the most recent data it can get from the IRS, and that data runs 2 years behind. So the premium you pay this year was decided by a tax return you filed a year ago, reporting income from the year before that. Why does that matter so much? Because retirement is full of one-time income events, a large withdrawal from a traditional retirement account, a Roth conversion, selling a home or a property, a year with unusually high capital gains. Any one of those can spike your income for a single year, and that single year can set your Medicare premium 2 years later, long after the money is gone. Picture someone who did everything right. They did a one-time Roth conversion in 2024 to plan for the future. Smart, long-term move. But that conversion pushed their 2024 income over a threshold. 2 years later, in 2026, the surcharge shows up, and by then, there's nothing they can do about that year's income. It's already locked in. Illustrative example, not financial advice. That's the second trap. The surcharge arrives on a delay, tied to a year you can no longer change. And it resolves the question from earlier. The reason people don't see it coming isn't the surcharge itself. It's the 2-year gap between the income and the bill. But there's one situation where this surcharge can appear even when your income hasn't changed at all. Here's the situation almost no one plans for. The thresholds are different for single filers and for couples. For a couple filing jointly, the first threshold is $218,000. For a single filer, it's $109,000, exactly half. Now think about what happens when one spouse passes away. The surviving spouse, the following year, generally files as a single filer. Their income may be almost the same: pensions, Social Security, withdrawals. But the threshold they're measured against just dropped from $218,000 to $109,000. So the same household income that was comfortably under the joint threshold can now sit above the single threshold. The surcharge can appear, not because anything was earned differently, but because the filing status changed. It's one of the most overlooked situations in retirement, and it tends to hit at the hardest possible time. And there's a second layer. IRMAA doesn't only apply to Part B, it also applies to Part D, your prescription drug coverage. In 2026, the Part D surcharge can add up to $91 a month on top of the Part B surcharge. Both stack. Both are triggered by the same income thresholds. So when you added up Part B surcharge plus Part D surcharge, applied per person, triggered by a cliff, decided 2 years in advance, you start to see why this catches so many people. It's not one rule. It's 4 rules interacting at once. So what do the official rules actually allow you to understand here? A few things, stated plainly, and none of this is personalized advice. First, the thresholds are public. The Social Security Administration and CMS publish the income tiers every year, and the first 4 tiers are adjusted for inflation annually. You can look them up directly on SSA.gov and Medicare.gov. Second, IRMAA is based on a specific income figure, your modified adjusted gross income from 2 years prior. Knowing which year is being measured is the single most useful fact most people are missing. Third, there is an official process for certain situations. If you've had what the SSA calls a life-changing event, and they define exactly what qualifies, there's a form, SSA 44, used to request a reconsideration. The SSA documents what counts and what doesn't. What none of this is a recommendation about your own income, your conversions, or your filing. Those are decisions for you and a qualified professional who knows your full situation. What Greyrock does is show you the rule, the number, and the source, so you can ask the right questions before the letter arrives, not after. If this is the first time you're seeing how the 2-year look-back works, you're not alone. It's one of the most misunderstood rules in the entire Medicare system. So here's a simple one. Did you know that a single dollar of income could trigger the full surcharge? Comment IRMAA below, I read them. And if you want the rule that quietly costs American workers the most before they ever reach Medicare, the breakdown of the hidden 401k fees is on screen now. Watch that one next.